I just published a video on the dividend discount model. The version I use is the Gordon growth model. This is the most simplified model, and it makes a lot of sense. And I think it's the easiest to understand as well. But feel free to email me, financial.business.consultant.sr@gmail.com, and I'll send you this for free. This is kind of like how a bond works, but I'll show you how you fill it in. You just have to fill in these 5 fields, and then the math is down here. So you can always, I encourage you to learn the math too, because the more you understand of the actual calculation, the better you can be at inputting. Because a valuation model doesn't really mean anything. It's the inputs, right? So if you have someone like Warren Buffett who's putting in the variables, I would trust that a lot more than just some guy on some website. So that's the hard part, the inputs. The good thing about these models is it's kind of like structured to where the inputs are kind of fixed in a sense. But let me just go through it with you. In the video, I just did AT&T. So put the ticker in. You only have to enter these 5 fields. That's it. And let me know in the comments. We can do other tickers. Of course, the company has to pay a dividend. If they don't pay a dividend, you can't use the dividend discount model. So it's currently trading at 23.18. 23.18. Then you want to put the annual dividend in there. And that could vary as well. I would put the most recent annual dividend. In Yahoo Finance, it gives you the annual dividend, $1.11. You can multiply the last dividend by 4. A lot of websites give you the actual, they annualize it. Okay, historical data. And a good way to learn how to get better at inputs is to kind of look at the data. So let's go. So they've been paying a 28-cent dividend for several quarters now. So 28 times 4. So it's $1.12. I think the reason it says $1.11, I think it's actually not 28 cents. It's probably like 27.5 cents. But you could also go to the statistics section in Yahoo Finance, and it shows you the trailing dividend. You always want to do the annual dividend. You don't want to put just for 1 month or 1 quarter. It has to be annualized. And then Yahoo Finance gives you the forward dividend, which is the same as the trailing dividend. The forward dividend is what they expect the company to pay over the next 12 months. So the WACC, we all know we can use Finbox for the WACC. So you go to Finbox, and they provide WACCs for you. So just put in AT&T, go to models, go to cost of capital, and then view. And they give you the various WACCs, 8.5 up to 10%. So you can use any of the WACCs you want. The lower the WACC, the higher the valuation will be. The growth rate may be a little challenging because we don't know how much they're going to grow their dividends. If it's a stable company like AT&T, I'd feel more comfortable giving them a higher growth rate than a company that's not really doing as well. But this is assuming you're assuming they're going to pay dividends in the future. So if you pick a stock that is likely to cut their dividend because they're not making much money, this probably wouldn't work that well, this model. So if you think they're going to grow it at 4%, say, a year, then the stock is worth $24.89. So it's a slight discount, a 7% discount. So it would be a buy. If you think that they're going to grow that dividend at a 3% rate, now it comes down to $20, the stock price. So it's not a buy. And you can play with the numbers. 2%, it's $17 a stock. You can move around the WACC too. If you think 8.5% is high. For AT&T, I could see a 7% discount. And make sure you email me. I could send you this Excel file. And I'm going to come up with new models often. And they're all free. So you just email me. Because there's a lot of nuances to these types of models. Because the Gordon growth model assumes the growth rate is the same in perpetuity, which we know that's not the case. So we can add another layer to this model where you can even have a 0% growth for like 3-4 years. And then starting in year 5, they're going to grow that dividend at a different rate. So you can alter. The problem with the Gordon growth model is it's fixed. But of course, in Excel, I can make it where you can adjust it. But I just did the basic one to start. And then I'll get more nuanced as time goes on. Because if you think about it, if you have a small business, and your profits, let me just do. Say you have a small business and revenue is $250,000. Expenses, assuming you don't pay yourself a salary, let's just assume that, and say expenses could be rent, supplies, payroll. So say this is for the whole year. Revenue minus expenses, $75,000. So whatever the profit is for the business is your salary. So you're paying, it's 100% dividend. In this situation, the dividend is $75,000. So you're paying 100% dividend. Now, if it was say it was a public company, and you could just assume this is 75 million or 75 billion because it's kind of a small number. And let's say they always pay half of their profit out as dividends. And a lot of companies do that. They do say, we will pay X% of net income as dividends. So 50%. So the dividend would be 37,500. Or if this is a million, 37.5 million. So if there was like, you could just pretend it's millions because it's, obviously a public company is not going to have. And let's say there's 1 million shares outstanding. So this is the nuance I was talking about. I'll do it in the second version of the discounted dividend discount model. So if they give 37,500, say this is just for a quarter. 37,500 in dividends. There's a million shares. So each shareholder gets 4 cents. It's probably not exactly 4 cents. Each shareholder gets 4 cents in dividends. So if you own 1 share, you get 4 cents for the quarter. If you own 10 shares, you get 40 cents, etc. So this is a good way to think about it, because say this was AT&T. Just say this was their numbers. So since they don't pay out 100% in dividends, it's actually a higher valuation. Because when you do the Gordon growth model, it's assuming 100% of the profits are paid out as dividends. And if the company retains some of the profits to grow the business, maybe to acquire another company or for CapEx purposes, then it's actually a higher valuation. So that's one of the setbacks with this type of model, is it assumes everything goes back to dividends, which usually isn't the case. So I guess for a REIT, this might work well, because a REIT pays 90% of its profits as dividends, which is a majority of their profits. But some investors, especially older people, some investors feel that dividends are how they get a return on a stock. They just view dividends because they actually see the cash going to their account, and they don't really view a stock going up in price as profit as much as a dividend. So it's pretty simple. There's not much interaction. But let me know if there's other companies. Like NVIDIA, you couldn't do a dividend discount model because they pay such a small percentage of their... Let's do a REIT. Does anybody have a Realty Income pays monthly? It doesn't matter if it's a monthly. So they're trading at 57.45. $57.45. And let's look at their annual dividend. And Yahoo Finance, it's good that they annualize it right here on the front page. You don't have to do any math. But it's good to look at the past, because another problem with these models is it's assuming they're going to pay the same dividend in the future. And if you look in the past, if you see the dividend is dramatically different, in this case, it's actually a perfect company to do this valuation on, because you can see they paid a 19-cent dividend for about a year, then a 20-cent, then 21. So it looks like they raised it about a penny a year. So this is like the perfect kind of stock to do it with. And the WACC is, well, WACC discount rate, same thing. Let's use the lower one. And this is the nuance I was talking about. So the last time they raised their dividend, it was from 25 cents to 26 cents. So now we can get the actual growth rate, because it's 1 over 0.25. So they actually grew it 4% the last time they grew it, because 1 penny from 25 to 26 cents is a 4% growth. So that's the actual growth. So in this case, it's a screaming buy. And if you think the WACC is a little low, let's do let's go with the higher WACC. Keep it conservative. Now it's actually, ironically, almost exactly where it's trading at. $60 is a calculated stock price. The actual stock price is 57. So the dividend really doesn't change, right? It changes every year. The stock price changes every day. So if you do a dividend discount model on a company like this, and even in a conservative situation, we're saying the stock is worth $60. So you see in the beginning of the year, it was, let's go back 5 years. So it was well under 50. It was in the 40s. That was during COVID. It got up to 76. So at that point, it was overvalued because at 76, it's just not worth it. But 60 is kind of like your kind of break-even point. But once it got low in the 50s, this was an obvious buy because it really has to get to 60. I mean, it's just giving free money away. And I know logically that doesn't make sense to people, but if you think of a bond has guaranteed payments. So if you buy like a $10,000 bond, and you get a 5% return, the interest payment is 5%. So you're guaranteed to get $500 a year in interest from this bond. So anybody would pay. It depends what interest rates are in the environment, but if anybody would pay for, if this bond was trading at like $7,000, $8,000, I mean, it would be a steal because you're guaranteed to get that $500 return. This is pretty much how bonds work. So in a high interest rate environment, you get a 5% return on this bond. But if interest rates start to come down, then the cost of this bond goes up. So it might cost $11,000, but you're still getting the same $500. So actually, you have to pay $11,000 and you get the same $500 return on the bond. So now you're only getting a 4.5% interest or yield. But bonds move on interest rates. So if the opposite happens, this is when rates go up. Sorry, rates go down. I mean, it makes logical sense, but it's a little confusing. And I know I'm trying to come up with a way to. So when rates go down, bond prices go up. Price of bond. I'll do a free Excel for bond prices, because if you understand how bonds work, then stocks, especially dividend paying stocks, make a lot of sense. Now, if the rates, when I say rates, I mean the rates in the environment, like the Fed funds rate. If rates go up, now the bond price goes down. So it might go down to 9,000. That's how much the bond, this $10,000 bond would be trading in the open market at 9,000 if interest rates go up, because you have a fixed interest rate. You're not going to change your interest rate. The only thing you could change is the price of the bond. You would never sell the bond for $10,000. Like if rates go up a lot, no one would want your bond, because why would they pay $10,000 for a 5% bond when the market is offering a 5.6% return on the same exact bond? So that's why you have to sell it for $9,000 to somebody, and they would get a 5.6% return. Scott, they have a lot of the small retail chain stores, and some are closing stores. So what margin of safety are you building in? And yes, the thing with dividend discount models, it doesn't assume a lot of that kind of risk. It's not really built into it. But like a DCF, you have a lot of options to build in that type of risk. But what you could do is, if you were concerned, like if you bought this stock or you wanted to analyze this stock, Realty Income, and we know the stock price, you know their current dividend, and you know what the market says their WACC is and the growth rate is. But if you were concerned, like Ed's saying, that there might be competition, maybe they might close stores down, then you adjust the WACC. Then you would just raise the WACC up, say, okay, instead of 9.3, I'm going to go up to 11 because, I could see big problems in the future. They may not be able to collect as much money on their tenants. So you just raise the WACC to compensate for the risk. But that's all you can really do. Or you can, obviously, the growth rate, you can adjust the growth rate too. So you can bring it down, the growth rate, to 3% or 2%. But the growth rate is pegged off of the action. I mean, we just did it. We looked at the actual growth rate. So assuming they continue that penny increase a year, there's no reason to adjust the growth rate. Of course, if you were investing in RIM and Zim, they were growing their dividend at like every quarter they were doubling their dividend. So you can't do that because you'd be a trillionaire if you kept doubling your dividend. But yeah, so it's definitely not. It's not meant for as many variables as a normal stock. This type of model, because it's very simple. It's just these inputs, and you can't really change much. That's why the DCF is kind of like king for valuation. But like if you have a small business, this totally makes a lot of sense because you can use this for a small business. It might be a little. Let's just say. Let me see if I could do it. I might have to change the model a little bit. So small business. Just say there's one share of stock. Your entire business is the stock. And say you value your business. Just to give you, generally a small business is valued at 1 times profit. Sometimes it could be 2, 3, 4 times profit, but usually it's like 1 times profit. That's a pretty good valuation. So let's just say you have $75,000 of profit. And that's your dividend, $75,000. Because remember, I said if you have a small business. Now, what's the growth rate for your business? Maybe inflation, maybe like 4%. So now it says your company's worth $1.1 million. Which, if you think about it, if you had a stock that was paying you 100% dividend, because that's what this is saying. This is saying your stock price is $75,000, and your annual return is $75,000. So you're getting 100% dividend, which is like no stock offers that. So you might have to just give them a really high whack. But a stock is different than a small business because when you sell a small business, usually the person buying the business has to kind of quit their job. That's their life. That's their job. So you're kind of replacing your job for that business. You're working like you're working full time. When you buy a stock, you don't have to quit your job and just focus all your time on that company. You just sit back and collect. if they pay a dividend, or you can sell the stock if the price goes up. That's why a small business doesn't have a great multiple, like a 1x multiple. Because if there would be no company that pays 100% dividend, because everybody would just buy the stock, and it would the arbitrage it would totally wipe out any type of arbitrage gain, and then it would just be a normal 5-6% yield. But yeah, let me know in the comments if you want to do a different. That's what I was hoping. So, and you should look this up, because if you want to understand stocks, this is a good start, because it's a very simplified. It's the most simple way to value a stock, the Gordon Growth Model. So try to understand the nuances of it, and you could use it for any stock that pays a dividend. Investopedia is the best. I've learned so much from Investopedia. I still do, but especially when I was like when I started the channel, there was a lot of like things I didn't know that well, or I couldn't explain it that well. Like I knew it, but if I was to explain it, it probably wouldn't come out right. So I would go to this website. So the Gordon Growth Model, it calculates the intrinsic value of a company's stock. So it assumes that a company exists forever, and there is a constant growth in dividends. That's a setback, because generally there's no company that is around forever, and there's no company has a growth forever in dividends. So you have to take that with a grain of salt. Would you consider MPW higher risk than zero? Oh, than O? Oh, without a doubt. They're not. It's like not even. It's day and night. Definitely MPW is much higher risk. The Gordon Growth Model works by taking an infinite series of dividends per share and discounting them back to the present value. But I'm hoping people use the model, because I want to come up with a part 2 to the model. Because the thing with these models is that, like, if you go to a website, right, and it just says to enter the variables into the website, and it gives you the value of the stock. That's great, but if you have it in Excel, then you can change the variables, because it doesn't make sense, the Gordon Growth Model. It's a very simplified approach, but it's a way to get you started. It is a variant, so it is a dividend discount model, the Gordon Growth Model, but it's a variant. It's just one type of model. It's like, so Gordon Growth is good for companies with steady growth rates. So if anybody has what's a good ticker? Does anybody know what a stock that pays about a 50% dividend? When I say 50% dividend, I mean half of their net income they pay out as dividends. And I think some company actually mentioned that in their 10K or 10Q. They'll say, we will pay out 50% of our net income in dividends. I'll show you what I mean. Pratik, what's up? Verizon, that's a good one. What's the what's that called? Net income over dividend. Net income over dividend is how you will identify return on revenue per share, quarterly dividend, total. It must be in payout ratio. So the payout ratio will tell you the percent of the net income that are paid out in dividends. AT&T pays out 300% of its net income in dividends, which is not sustainable, right? which doesn't seem to make sense. But you can do that in 1 year. You can have a 300% payout ratio, but you can't do that every year. Does anybody know why it's so high? Well, I do, but does anybody know why it's 300%? Zim does 30 to 50%. They've done 100%, but 30. Yeah, okay, that's a good one. Vishnu, thanks for your stream, Scott. Alberto Leon Sebrion. Did I say that right? Is it Sebrion? No, wait, a C in Spanish. How do you say a C in Spanish? How is a C pronounced? It's Kebrion? How is the letter C pronounced in Spanish? Sebrion. Okay. I get stuck on things. It's my Asperger's. I can't focus until I have a Verizon. That's a good one. Verizon. It's just a tool. All these Excel models are tools, and it will help you a lot, these tools. I want to just show you an example of how you can use it. And I know someone said, why don't you just have your Excel, why don't you have plugins in Excel where it pulls the information automatically so you don't have to go look for it? I think that's good. I think that makes sense. But if you ever work at a company and you work on these, whether it's an Excel model or regular computer program, and all you have to do is input the information and it gives you the result, you'll never really understand your job that well. Once you understand the model, and once the model breaks and you could put it back together, then you'll be a master. But if you're just inputting, you're never going to really understand things. So that's why I think you should try to understand the model and when it falls apart, because so you know how the growth rate is we definitely don't know the growth rate, but you can just look at their actual growth rate. And I will put that into when I do version 2 of this model, I'll have that input where you can calculate the growth rate by just inputting. So if you look at their history, I mean, it's a lot easier to do on a company like this. But if a company has their dividend goes up and down, then there's no way to calculate the growth rate. So in 2021, they paid 63 cents, then 64, 65. It jumped 2 cents. Let's do the 2 cents over 68 cents. So that's a 2.9% jump. So we're assuming a 2.9% growth in perpetuity, which is probably fine with this company. If you're doing Zim, who knows if the company will be around or if they'll pay a dividend. They're going to almost definitely be around and paying a dividend. So yeah, so this gives you a price of 54. So if the stock gets, let's see, if the stock, what happened? If the stock gets real low, it's like they're just giving you money. So you got to buy these stocks if they get real low. If you understand, if you use these models, it'll totally make sense. So you see it was down to 31. It was as high as 60. So when it hit 31, it was a steal. Like it's kind of guaranteed to get back up to at least 40, possibly 50. It can't trade at these low levels forever because they pay a dividend, and just the dividend alone makes the stock worth $54. You have to build in some risk, of course, because what if they don't pay? What if they remove the dividend? What if they lower the dividend? It's probably not going to happen with Verizon. I mean, they've probably been paying a consistent dividend for like 30 years. It's so you're kind of like, it's like free money, but I mean, it's not exciting to get an 8% return or 10% return a year, even if it's free. We want big returns. We want to be millionaires, like by Nvidia. There was a rumor about cable lead issues in 2023. I wish I bought at 29. We really need to see 10Q. Sometimes Yahoo Finance numbers are way off. I don't think so, Pratik. I think people are way off and they don't understand the numbers. It's usually correct. I'd say 99% of the time it's correct. If you're looking at like a company that has a mortgage insurance company, then it is a little sometimes those weird companies, the financials aren't correct. But I would be very shocked if a company like Verizon had any mistakes in Yahoo Finance, because it's totally vetted by so many people along the way. Because if you think about it, if just on the dividend alone, the stock is worth $54, if they paid only 20% of their, that's what I'm going to build that into the model. How to evaluate, not only value it with the dividend, but also adjust the valuation based off of their payout ratio. That's what you, as a good investor, that's what you really need to do. Because they pay out 116%. So you can't really adjust it. Actually, you have to adjust it down in this case, the valuation, because they pay more than their net income. But it's kind of like that small business scenario. If you had a small business with $75,000 of profit, say you took a salary of $50,000, and you would use the other $25,000 to maybe expand. Maybe the business next door, you want to break the wall and make yours bigger. So you use $25,000 a year to expand your business, whatever you want to do. Maybe hire a key employee with that money, or acquire another business, or whatever. Give me an example, Pratik. Give me an example of what's wrong Yahoo Finance. And I'm not just trying to critique you or criticize you, but almost every time someone said that to me, I explained why it was actually correct in Yahoo Finance and why they were wrong. But just give me an example of something that's wrong in Yahoo Finance. I mean, there's nothing wrong if you because a lot of times people would say, the dividend is wrong or the yield is wrong, but they were looking at it incorrectly because they didn't realize it's the annual dividend. People were like calculating it differently. But yeah, anybody, just give me an example. And okay, so what other stock? Zim's a good one. So the annual dividend is $1.16. Statistics. So I highly encourage you, if you get these models, it would be good to, because you'll have more questions on the live stream. If you get these models and play around with it, this is how I would play around with it if I was you. Actually, this is how I do it. So I would pull the dividends, what they actually paid, because what a company actually paid is good information. Because if they paid these dividends in the past, there is a chance they'll pay these dividends again. So this $1.16 that I input, you see this $1.16? The way they got that is that's these two dividends combined, because the past 12 months they only paid two dividends. This 23 wait, let me think about it. So we're looking for November 2023 through November 2024. What dividends did they pay? So they only paid two in the past 12 months. This April 2023 dividend was in the prior period. But let's use this $4.75. And that's only one payment. They did another one the following quarter. So let's just assume they paid $4.75 for the entire year, even though that was just one quarter. If the stock is worth $68 if they get back up to that level. But if they did pay a $4.75 dividend, then people would buy the stock, and that forces the stock price to go up. Let me. Say they. It's just the mechanics of the stock market. That's why the stock price got so high when they were paying these huge dividends. So let's just say, for fun, today, say they announced, they said, we're going to pay our next dividend, we're going to pay $4.75. And I'm not even saying for a quarter, I'm saying for the entire year. That means the stock is trading at $24. That's a 20% yield. What do you think would happen if a company was offering a 20% dividend? People will buy the stock, of course. Even if, so over the next 2 months, I would say a lot of people will buy the stock. And that dividend is the same. They usually change the dividend every quarter, every year. So when people start buying the stock price goes up. Now the stock is up to $40 a share. It's still a 12% yield. And if they actually pay the dividend, let's say it is for the year. So that implies they're paying $1.19 per quarter. So say a quarter passes, they pay the $1.19. Then more people will buy the stock, because if they're actually paying the dividend, people feel a lot more secure about buying the stock. and then it forces the stock up to $60. Now the yield is 8%, which is still a great yield. And if another quarter goes by and they pay that dividend. So that's just how the mechanics of the stock market works. If there's a situation to make money, like an arbitrage situation, that the kind of the guaranteed return will go away. Or the opposite, if a stock is really overvalued, like they cut their dividend and the stock goes down, then you'll see a big sell-off and the stock price goes way, way down. Neil, what do you mean maybe not? If a company is consistently paying a really hefty dividend, people will pile into the stock until that dividend goes away, which is what happened with, I mean, the market reaction may not be overnight. It may take a few months or sometimes a few years. If they consistently paid that huge dividend they used to pay, like they paid $17 once, and that was just a quarterly dividend. They can't consistently pay that because the stock would go through the roof. That's why people didn't jump into the stock, because there was concern they wouldn't be able to pay it, which they did. They cut it down, but it was still the yield was still through the roof. And if you bought the stock in 2021, even if the stock went to zero, you still would have had a great return, because on the dividends alone, you probably made a few 100%. Well, let me just show you. I mean, I know what you're saying, but let me show you. How do you look at historical? Okay. So when they IPO'd at $10 in 2021, you could see the bottom. It got up to 150 million. 150 million shares purchased at the peak. That was in the beginning of 2022. It happened again. Actually, they broke their record. They had almost 300 million people buy the stock in the first month of 2024. So this is exactly what I said. They were offering an amazing yield, and the only way a stock goes up is if there's buyers, and the only way a stock goes down if there's sellers. So there was people piling into the stock and brought it from 1150. The very peak was 91. So it went up like 8x, almost 800% from 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, over 15 months. And then in March 2022, So there was lots of buying activity up through March 2022. And then there was a big sell-off pretty much all through 2022, almost the entire year, starting in January, February, March, starting in April 2022, a huge sell-off. So they paid a $17 dividend in March 2022, and then they cut it to $2.85. And that coincides with the sell-off. But the people probably shouldn't have sold off because they were still paying a dividend. And then in January 2024, people started buying it again. It's just supply and demand. That's just how stock prices move. Why do you think they choose to pay out their dividend in such a variable manner rather than retain the earnings? That's just how, that's what I think sometimes too. Like, why do companies pay out? But it just may be part of the, like they might have written that into their they don't have a 10K, but whatever their annual report is. Like we can see it. I want to see the annual report from 2022. They just write it into the reports that they pay out 50% of their profits as dividends. So they were just so profitable, especially this quarter, but they were really profitable. And the shareholders own the company. So why would they retain it? I mean, they're not paying it all back in dividends. Like if the company had $1 billion of profit and they wrote in their reports, we pay out half of our profits in dividends, more people will buy the stock if they know the company, even before the company actually pays a dividend, people feel comfortable seeing that the company will pay X amount in dividends. So if they have $1 billion of profit, they have to pay out $500 million of dividends. And say that $500 million is a 5% return. So this is what they expect. Like say a company expects $1 billion of profit, half of that goes to the investors in a dividend, so that's a 5% yield. But let's just say, I mean, and this happened because it's such a volatile industry. Let's say for some reason they made $10 billion of profit in the next quarter because there was so much demand and prices were going up so much. So they have to pay it. They can't just say, "Oh, we made too much money, so we can't pay you. We did promise you 50% of our profit, but now we're not going to pay you because it's too high." So they kind of have to pay it. I mean, they could have put a fixed number on it. They could have said, "We'll pay you $500 million of dividends each quarter," because they think they're going to get $1 billion of profit. But what if they didn't get $1 billion of profit? What if like rates go down and they got $300 million in profit for the quarter? They promised $500 million in dividends, so they have to pay it. This happens a lot. A lot of companies, a lot of car companies, they have to just keep taking on debt to fund their dividend payment. Coca-Cola, Exxon. Yeah, but I think by like what we're doing here, talking about it, I think it'll give you more insight than just plugging numbers into a model. Yeah, Coca-Cola is a good one. So they have to pay a dividend for it to be so $1.94 and $64. So this says the stock is worth $97. I gave him a low whack if you want to raise the whack. But even if, even for example, if the, say they paid $1 and the model says the stock is worth $33, that doesn't mean you should not buy the stock, because what about companies that don't pay a dividend? Then why does anybody buy those stocks if a company pays no dividend? Because you have to look into it's not just the dividend, it's the appreciation of the stock price. Those two things is how you make money. When a stock price goes up, you have a paper gain. Once you sell it, then you realize the gain. So if, for example, say Coca-Cola paid a $1 dividend and it says the stock's worth $33, that's when I said you should look at the payout ratio. But they don't. Does anybody know a company that pays like not a huge dividend, but not an NVIDIA dividend, like a normal dividend, but not like what we've been looking at, like maybe 20% of their payout? Because, like I said, if it, in this case, this is not a good example of Coca-Cola, but if, say, they did pay a $1 dividend and you calculate $33 of stock price, that doesn't mean you should not buy it. You should look at other things. You should say, you should look at how the stock moves over time. If it doesn't move up much in price, then you probably should avoid it, because if you're not going to get a stock appreciation in the stock price, then why would you overpay for the dividend? So you know what I'm saying, I think, right? So you just have to look at those variables. But a company like this, a dividend discount model is what you'd want to use. It's much more reliable because they pay out 79% in dividends. The stock probably won't go up that much. It's not going to like, there's no chance of it like 10xing. With a tech stock, I mean, even NVIDIA was tripling in price. They were trillion and they ended up with almost 4 trillion now. Thanks, guys. Have to check out the rest of the presentation. Okay, yeah, thanks for joining. Okay, so yeah, I just wanted to go through it. I think it helps me too, because when I talk about it, then I can like adjust the model and come up with different ways. But yeah, everybody just email me if you want a copy of this, and it would be good to go through these live streams with people who've used the model. Okay, so I guess I'm going to sign out now. I want to finish up some other videos. Thanks for joining. I'll talk to you later. Well, yeah, if a company doesn't pay a dividend, you want to use the regular discounted cash flow model. But I'll come up with, I want to like come up with different scenarios, because that's how you learn about the market. So like you can build into these models the dividend, buybacks. But yeah, next model, I'll add buybacks or something like that. I think it'll be good. It's not just good for you. I mean, of course I want to help you, but it's good for me too. The more I think about it. But yeah, okay, Pfizer. Let's do Pfizer. I thought, because actually I was thinking about buying Pfizer, even though I'm down a ton on it. $1.68. The thing with Pfizer, it's so beaten down, the stock. It's going to seem like a buy in almost any model. Because I mean, it should be trading at like $50. Like that is the intrinsic value. But people, but a stock is different than a bond, because with a stock you can lose your principal, right? The stock price can go down. With a bond, you pretty much can't lose your principal. Your oil and gas, this is great. It's great for REITs, oil and gas companies, or really big stable companies like AT&T, Verizon, like the ones we did, or okay, yeah, email me and I'll send you this model so you guys could kind of play around with it, and then you'll really understand it, especially if we do this back and forth. Yeah, Kinder Morgan, all those midstream companies, this is perfect. It's much easier than a DCF. Okay, sounds good. So thanks a lot. I'll talk to you later.